Good afternoon, entrepreneurship class, Business 149. This is Professor Robinson here. Just wanted to take a few minutes to go over financial statements. A part of our week 2 discussion and course material. We'll be discussing financial statements, and I wanted to give you a little bit of commentary to assist with reading the PowerPoint slide that addresses financial statements. So I'm going to pull up the financial statement slide and add some commentary. You'll see what questions may arise throughout the week, but I wanted to give you something that you could sort of connect the dots between the PowerPoint and some of the concepts that are presented in the PowerPoint that's presented here. Just give me one moment. So what you're looking at right now on your screen is what is called the accounting equation. This accounting equation is really the very foundation of accounting. The equation is assets equal liabilities plus owner's equity. And what this is also equivalent to is what is called the balance sheet, or the company's statement of financial position. So it represents the health of the company. And so what you'll see is that assets are equal to the liabilities and the owner's equity. And how you could really view this in a different light, you can say what the company owns is made up of what is owed to creditors and what claims they have on those assets. In other words, once the company has taken care of all of its liabilities, what would be remaining? And so it really represents what is called net worth. After all obligations are paid, what is the company valued at? What actual claims does the company have on the assets? This is a very important equation. As I mentioned, it is the foundation of accounting, and it represents the strength, the financial health of a company. Here in this slide, what you're seeing is really a progression of the financial statements. What you have is the income statement, which represents income minus expenses. I know you see multiple lines here: revenue less expenses, operating income plus gains and losses, etc. But mainly what you want to take away from the income statement, it is revenue minus expenses, what the company brings in by virtue of selling its product or services, minus the expenses it takes to run that business. That will leave you what is called net income, that the revenues exceed the expenses, or net loss if the expenses exceed the revenue. Much like if you look at it from a household standpoint, it is your income that you have each month minus any costs you have to run your home, utilities, mortgage, rent, etc., groceries. What is left over is what, from a business standpoint, is net income or net loss, depending on what the balance is between revenue and expenses. From the income statement, you take the net income, which is encircled or boxed in bold, and you take that to the statement of retained earnings. The statement of retained earnings represent the profits of the company. Profit is simply what is left over after the company takes care of its operating expenses to run the business. So income comes in, expenses go out. What is left is the net income. That goes on the statement of retained earnings, and it has the beginning retained earnings, which would be from the prior year, plus the net income of the current year, and any dividends that are paid out to shareholders. So if you are a corporation and you have shareholders, then those shareholders, you could declare that you want to share those profits with the shareholders. And so I can get into more detail with that, but I'm going to leave it there for our purposes. And the ending retained earnings balance is what is then placed on the balance sheet. This statement of owner's equity, really and truly, they're kind of one and the same as statement of retained earnings. So I don't want to confuse you. Really what happens is your retained earnings ending balance goes into the equity section of the balance sheet. And so really, that is the three financial statements that you receive for the current period. Then you have the statement of cash flow. Statement of cash flow is going to show cash receipts and cash disbursements throughout the year. And it's going to show you where cash actually went in your organization. So while the income statement represents earnings, the statement of cash flow represents the cash that has been moved in the company, either inflow of cash or outflow of cash. When you look at the income statement, you look at earnings, your revenue could be by virtue of cash or by credit, because you can have credit sales, which does not actually mean cash is coming into your business, which is why the income statement represents the earnings of the company, both cash receipts, cash sales, and credit sales. Statement of cash flow speaks specifically to where cash is going in the company, either cash inflows or cash outflows. And as we get through the course, what you'll notice is we'll go into more depth on these. So really right now, we're just kind of operating at a high level on these concepts. When we get to the income statement, this is an example of a single step income statement. In other words, it just has revenue minus expenses. And so in this case, it would just be revenue and gains, which represents sales, income from leasing, gain on sale of equipment, and then expenses and losses, outgoing expenses for the business. The difference between the 259,500 and the total expenses and losses of 176,200 will give you a net income of 83,300. If these numbers were flipped, then of course it would be a net loss, because then the expenses would exceed the income or the revenues. So again, net income whenever your revenues exceed your total expenses. This next slide shows what is called a multi-step income statement. And a multi-step income statement simply is saying that this is a manufacturing company. So whenever you manufacture, let's say you're making furniture, let's say you're making tables, you're making desks, whatever the case might be, the cost in making that unit will be found in the cost of goods sold. That represents your labor, your materials, and your overhead. And so those costs will be summed up in the cost of goods sold. That gives you, after you subtract your cost of goods sold from your revenue, that gives you your gross profit or gross margin. Then you have your operating expenses. Then you have what is called your total operating income. Once that is subtracted, then you have income from leasing, less interest expense, and so forth. So again, there's multiple steps in this particular income statement. Usually you will see a multi-step income statement when you're dealing with a manufacturing company, because there is that line item called cost of goods sold. This next slide deals with the balance sheet. And these are some really good questions to kind of consider when you're considering the balance sheet and what goes into those numbers that show up on the balance sheet. What does the business own that can be turned into cash within a year? What does the business own that will produce revenues for more than 1 year? What other things does a business own, such as investments, patents, copyrights? So here, that's the asset section. What the company owns, those things that can be turned to cash within a year. Long-term assets, which will take a little bit longer for them to be converted to cash, and also are used to generate additional revenue, and then other assets. That will give you your total assets. Then you have what debts does the business have that must be paid within a year? Those are current liabilities. What debt does a business have that will take longer than a year? Long-term liabilities. And then how much is the business worth to its owners? And that goes back to what I said, claims on the assets. Once I've taken care of all of my obligations, current liabilities, long-term liabilities, what claims do I have on these assets? That's going to give me my owner's equity. And so current total liabilities plus owner's equity will be equal to my total assets. Balance sheet, again, this is showing a balance sheet as it relates to 2 years, 2011, 2012. What you'll notice is this comparison, you will be looking at these numbers in order to develop your statement of cash flow. Is there a cash inflow or is there a cash outflow? And so you're able to see those numbers and get those differences as you go through these line items, except for cash, because when you get to the very end, you will see the net change in operating activities, investing activities, and financing activities. Those are the 3 sections of the statement of cash flows, and your balance sheet will help you to see where those inflows of cash or outflows of cash are taking place. That concludes the kind of the high level representation of the financial statements. Of course, as we go through the course, you'll discuss them more thoroughly, but I did want to at least present them along with the PowerPoint slides so that you have some way to connect the dots between just the slides and the actual data that's inside the slides. You want to have some kind of connection. So again, ultimately, there are 4 financial statements: income statement, statement of retained earnings, balance sheet, and statement of cash flow. And so you want those reports or those numbers, financial reports, to be available to your prospective investors, because they want to know if they are to invest in your company, will they get a return on their investment? And so that is very important that you have the financial numbers. And usually, from a startup perspective, it's usually going to be what is called pro forma financial statements, or what, in essence, it says projections, what you anticipate based on your research, based on the market, how you have understood it and investigated it, and therefore you'll be able to manage it accordingly. So with that, I'm going to stop there. Hopefully there are some items that stood out to you that you can kind of now connect the dots between the financial statements and how it connects to your business. Of course, if you have any questions, as you all have already done, reach out to me by email. I'll be more than glad to answer any questions. We will meet in the course for Tuesday at 9 a.m. Again, we'll facilitate any updates as it relates to assignments and go over anything as it relates to the concepts for week 2. We'll be focusing primarily on marketing globally, international marketing, and how there is a different type of approach and strategy that you have to incorporate so that you can be effective in a global environment. So with that, I will see you all this week, and have a great evening. Talk to you soon.